Hi, this is Perry Moore with Payne Wealth Partners. Wanted to address a question that we've received quite a bit in the recent past, and it's something that has to do with a strategy that's being proposed by others in our industry, and that is preserving funds in an HSA, health savings account, for covering retirement living expenses later on in life. And instead of using those HSA funds to cover current medical expenses, using cash flow and covering those medical expenses out of pocket. So the first thing that I would say when it comes to a question like this is it is incredibly particular when it comes to whether or not that might make sense for your situation, because of the fact that so many different variables apply to that equation. And so everybody's going to be facing a different situation when it comes to their current and future income tax rates, rates of return, how they're investing, the character of their balance sheet, their cash flow today and in the future, their goals, all kinds of different stuff that can really change the outcome of whether or not a particular strategy makes sense. So I would caution against using rules of thumb when it comes to any type of financial decision like this. Secondly, I'd like to just take you through some really quick math that generally hits on that topic and dives a little bit into the details that surround that kind of a decision. So I'd like to start with an example. So let's assume that you've got an HSA with $100. You have cash of $100. And you have medical expenses outstanding that must be paid from one or the other of $100 as well. So the first example, and what is being proposed by many, is to use up your cash. Invest your HSA, hold it to retirement, and then use it for retirement living expenses. Let's assume that makes 7% and you're 10 years away from retirement, and let's round and assume the rule of 72 gets you to about double. So now, in retirement, you have $200. You pull the $200 out to cover retirement lifestyle expenses, and you pay ordinary income tax on that full amount. Now, for most people, that federal income tax rate is going to be 25 to 39.6%. You also have state and local taxes, and let's take Indiana and Vanderburgh County and round up to about 5% for those taxes. And then in particular circumstances, this HSA distribution could subject you to other taxes on other types of income that you have at that point in time, like the Medicare surtax on investment income, which is another 3.8%. So the bottom line of that is your ordinary income tax rates total for most folks will range anywhere from 30 to almost 50% on that HSA distribution. And that's assuming that current income tax law does not change between now and when you retire. So on the low end, that's minus 30%, which is $60, and that leaves you $140. On the top end, which will apply to successful business owners, high-income earners, even in retirement when they're replacing all of the cash flow that they need to continue their current lifestyle, that could be as much as $100 in tax off of the $200 balance, which would leave $100. So then your alternative is to take your HSA, use it for its intended purpose, use it completely income tax free today to pay for those medical expenses, invest the cash, and let's assume, because you'll have to pay some income tax along the way as that account grows, depending upon the type of growth of that account, that instead of making 7%, you make 6% after income taxes. Now, keep in mind, there are incredibly income tax efficient ways to invest that cash that get close to what we're looking at on the HSA side. Not complete income tax deferral, but incredibly efficient. So we're being conservative here. And let's assume that $100 over 10 years at 6% grows to 6% growth. Grows to $180. So now you take the $180, pull it out of that account to pay for current retirement lifestyle expenses, and you're going to pay tax on that $80 of growth. And if your advisor is using the appropriate asset location strategies, most, if not all of that, should qualify for preferential capital gain tax treatment, which ranges anywhere from 15 to 20% currently, plus state and local income taxes and Medicare surtax for high-income earners. So let's say conservatively you're paying now 30% on that growth, and let's round up to $25 in tax. So 30% on the 80 equals 25 in tax, and you subtract that off, and you have $155 spendable value versus the $140, or if you're in the top income tax bracket, as little as $100 from the HSA. So clearly, you're better off using the HSA to cover current medical expenses, preserve your cash to either pay down debt, invest in your closely held business, invest in a brokerage account, investment portfolio, or do other things that will advance the growth of your balance sheet over time. Hopefully this has been helpful. One other thing that I would mention as to this, there is a medical expense deduction that could potentially help this side of the argument. The phase-out has been increased significantly for qualification of that deduction, so now that's at 10% for those under age 65 of your adjusted gross income. So for the vast majority of folks, there is no income tax benefit for paying for medical expenses out of pocket and using cash. So that would be the other caveat that I would add to this equation as well. So hopefully this is helpful. If you have any questions or would like to discuss this any further, particularly when it comes to your circumstances and your specifics, just give us a call. We're always happy to help. Thanks a lot.